Achieving a consistent 20% growth on your investment portfolio each year is no easy feat. In fact, even some of the world's best investors, like the famous Warren Buffett, have only managed to achieve returns around 9 to 10% annually over the last 3 decades. But that doesn't mean it's impossible. The Warren Buffett portfolio has returned an impressive 9.91% annually with a 13.66% standard deviation, surpassing the S&P 500 but falling short of the Nasdaq's returns. To grow your portfolio by 20% annually, you would need to significantly outperform the Nasdaq. In fact, you'd be doubling your money every 3.6 years. While this may seem daunting, the right investment strategy can help you get closer to those ambitious returns. In this video, we'll walk you through some of the most promising high KGR stocks that could help you achieve those 20% annual returns, while also emphasizing the importance of a diversified approach. To consistently hit those 20% returns, investing in high-growth stocks is a key part of the strategy. But remember, even the best growth stocks may have ups and downs. That's why balancing them with defensive stocks and dividend stocks is also essential. But let's dive into some stocks with huge potential for growth, starting with one of the most exciting names in law enforcement technology, Axon Enterprise. Axon Enterprise, Axon, is a leader in providing law enforcement tools like tasers, body cameras, and other technology to enhance public safety. As demand for security increases globally, Axon is well positioned for strong growth. In Q1 2024, Axon reported a 34% revenue jump, surpassing expectations by $19 million. With major projects like their acquisition of Dedrone, which will enable law enforcement to deploy drones more effectively, and their AI-assisted software, Draft One, designed to save officers valuable time, Axon could easily hit a 20% annual return for investors if the market supports its premium valuation. Next up is Celsius Holdings, a rising star in the energy drink market. Celsius reported a staggering 37% revenue growth in Q1, and it's rapidly gaining market share in the energy drink segment. With strong innovations and new product lines gaining popularity, Celsius is aiming to become the top energy drink brand globally. Despite a premium price tag, if Celsius continues to execute, it could easily deliver those 20% plus returns that aggressive investors are looking for. Another stock to watch is Howmet Aerospace, a leader in advanced solutions for aerospace and transportation industries. The stock has been performing exceptionally well, up nearly 95% in the last year. Its 23% growth in the commercial aerospace segment and continued demand for private jets are key factors driving this success. With strong earnings growth and a growing aerospace market, Howmet is primed to continue delivering impressive returns for investors seeking a 20% annual growth rate. Let's talk about PDD Holdings, the parent company of Temu, one of the most downloaded apps in the world right now. PDD's revenue surged an incredible 131% last quarter, and it's focusing on expanding its product offerings and partnering with top global brands to drive further growth. With China's growing middle class and increasing demand for higher-end goods, PDD is positioned for incredible growth. The potential is huge, making it one of the top high KGR stocks to consider. Plexus Corp is another name that should be on your radar. This company has consistently delivered around 20% annual returns, and its most recent results show revenue growth and strong new program wins. Plexus is expanding margins, generating impressive cash flow, and making smart moves in the industrial and healthcare sectors. If Plexus continues this trend, it could very well be on track for solid gains moving forward. Manhattan Associates is a leader in supply chain and online shopping solutions, and it just reported a 15% revenue increase. The company's cloud revenue jumped by 36%, and with a growing backlog, the future looks bright. With strong fundamentals and increasing demand for cloud-based solutions, Manhattan Associates is another stock poised for significant growth. And finally, Booking Holdings, an established name in the travel industry. Despite concerns about the travel market slowing, Booking's revenue growth and adjusted EBITDA have surged, and their connected trip feature is gaining traction among travelers. With continued growth in travel bookings and improved profitability, Booking Holdings could deliver over 20% returns annually, even in a post-boom market. These 7 high CAGR stocks each have their own unique opportunities for growth, and together, they make for a compelling portfolio for those targeting 20% annual returns. However, it's important to balance your growth-focused investments with defensive and dividend stocks to reduce volatility. By carefully selecting high-growth stocks and balancing them with more stable investments, you can position yourself to achieve those long-term financial goals. As always, do your research and consider consulting with a financial advisor before making any investment decisions. Thanks for watching. If you found this video helpful, don't forget to like, comment, and subscribe for more investment tips. Stay tuned for our next deep dive into the world of high-growth stocks.